Ocado Group shares fell nearly 15% to around 150 pence, sliding below the 180 pence at which the company debuted on the London Stock Exchange in 2018. The trigger was Kroger, America's fourth largest retailer, announcing it would close 3 of Ocado's robotic fulfillment centers in Maryland, Wisconsin, and Florida in January, wiping roughly £350 million from Ocado's market value in a single session. Kroger's statement was clinical. It had identified opportunities to optimize its fulfillment network and would shift toward capital-light, store-based automation. Shore Capital analyst Clive Black was less restrained, calling it a near knockout punch, and saying Ocado was being marginalized because most of its fulfillment centers do not work economically in the USA. Sobeys in Canada moved in the same direction, announcing further warehouse closures. The question underneath all of this is not whether Ocado can recover the termination fees. It can, and it will receive more than $250 million. The question is whether the centralized robotic warehouse model works at mass market scale, or whether it is permanently limited to dense, affluent urban pockets. Ocado's first half results appeared to show strong momentum. Group revenue rose 54% to £1.04 billion for the 6 months to May 31st, 2026. But $354 million of that total was one-off termination fees and accelerated revenue recognition from the Kroger and Sobeys closures. Strip those out, and underlying revenue grew just 1%, essentially flat across the entire business. Underlying adjusted EBITDA, stripped of closure impacts, fell 12% to $81 million, and the underlying net cash outflow worsened to $147 million from $108 million a year earlier. Technology Solutions, the arm that licenses Ocado's warehouse platform to global partners, saw both revenue and profit decline. The number of live modules fell. The business that was supposed to demonstrate Ocado's value to the world got smaller as global retailers chose to exit. This is the buried structure of the H1 report. The closures generated the income that made the headline look good, but the closures themselves are evidence that the model did not work for the partners paying those fees. Ocado's highest revenue half is built on proof that its biggest customers decided to leave. Peel Hunt called this real progress. Shore Capital called it a near knockout punch. Both are reading the same numbers and arriving at opposite conclusions. And that gap is not a framing problem. It is the genuine, unresolved question about whether the model is structurally viable. Freetrade's Duncan Ferris captured the problem directly. Termination payments are not a sustainable growth model. What Ocado needs, and does not currently have enough of, is new signed technology contracts with retailers. The closures cleared the balance sheet of loss-making obligations, but they also reduced the active partner count, narrowed the proof of concept footprint, and shifted the burden of proof for the platform's commercial viability onto a smaller number of remaining sites. Inside the same set of results, one business is performing strongly. Ocado Retail, the UK joint venture with Marks & Spencer, reported revenue growth of 15% in the first half. Adjusted EBITDA more than doubled to £73 million, and the number of active customers reached 1.28 million. Its fulfillment centers are running at 103% of original design capacity. If this part of Ocado were the entire company, the investment case would be clear. The Technology Solutions arm is moving in the opposite direction. Revenue and profit fell, the number of live modules fell, and 2 critical sites missed their launch schedules. The Kroger Phoenix warehouse was pushed back by a full year. The Lotte shopping site in Seoul was also delayed. International volume growth of 27% year-on-year is cited as evidence of momentum, but that figure excludes the Kroger and Sobeys sites that are closing. Measured across the full contracted network, the volume story is not a recovery. There is genuine new momentum on the contract side. Ocado signed a deal with Asda to deploy its smart platform across Asda's entire online operation from early 2027. Steiner said the company has live engagement with potential U.S. partners and multiple new grocery prospects across North America, Europe, and Asia Pacific. The Asda contract matters because Asda is the UK's third largest supermarket, and a successful deployment would restore the proof of concept credibility that the Kroger exit damaged. But the core commercial challenge Kroger raised explicitly remains unresolved. Kroger's pivot to capital-light, store-based automation is not just an operational adjustment. It is a statement that high-capital, centralized robotic warehouses do not deliver acceptable economics across a dispersed, mass-market consumer base. Asda serves broadly the same demographic in the UK. Whether the Asda deployment works at scale under UK economics and consumer density is the test that the Kroger exit has now made unavoidable.
Ocado is carrying a significant amount of institutional faith. Management committed that the second half of 2026 will deliver positive free cash flow, and that fiscal 2027 will be fully cash flow positive. The $150 million cost reduction program, with the vast majority of initiatives actioned in the second quarter, is expected to show through in H2. Liquidity remains solid at just over $1 billion, with more than $700 million in cash. The balance sheet can absorb the current burn rate. The governance dimension adds a layer the numbers alone cannot resolve. Chair Adam Warby reportedly initiated a search for a new chief executive without consulting Tim Steiner, triggering backlash from long-term investors who threatened to seek Warby's removal. At Thursday's results presentation, Warby made no public comment, an unusual absence for a chair. Steiner, who has collected nearly $100 million in pay from Ocado since the 2010 IPO, insisted he was not standing in the way of succession and was as excited about Ocado's future as he had ever been. The succession plan is set to run to 2027, with Steiner staying in a founder role through 2029. For the holder, the question is whether the H2 cash flow turn materializes, and whether Steiner's succession creates disruption before the Asda deployment goes live in early 2027. For the watchlist investor, the stock is trading below its 2018 IPO price, and the bear case, that the model is structurally uneconomic outside dense urban markets, is now grounded in two major partner exits, not one. The decision variable is not the H2 cash flow print itself, but what happens to the US partner pipeline. Steiner said signed US contracts should emerge within the next 6 to 12 months. A US contract signed within that window, alongside Asda running on schedule from early 2027, would be the clearest evidence that Kroger's exit was a customer-specific problem, rather than a model-wide verdict. An Asda delay, mirroring Kroger Phoenix and Latte Sol, would confirm that the centralized robot warehouse cannot hold its deployment schedule against the commercial pressures of mass-market grocery, and the recovery story would lose its final credible anchor. That is the single variable worth watching before any position is taken.